The year was 2008. The global economy seemed to be riding a wave of prosperity. People were buying homes, businesses were booming, and the stock market was soaring. But beneath this shiny surface, trouble was brewing. Few saw the warning signs, and even fewer could have predicted the chaos that was about to unfold. This is the story of the 2008 stock market crash, a financial earthquake that shook the world. The crash took many by surprise. It seemed to come out of nowhere, but the roots of the problem ran deep. To understand what happened, we need to take a closer look at the events that led up to that fateful year. At the heart of the crisis was the housing market. For years, home prices had been steadily rising, creating what's known as a housing bubble. Banks were giving out mortgages like candy, even to people with poor credit and low incomes. These risky loans, known as subprime mortgages, were packaged together and sold off as investments called mortgage-backed securities. Investors around the world were eager to buy these securities because they offered high returns. What they didn't realize was that these investments were built on a foundation of shaky loans. When the housing bubble finally burst and home prices began to fall, people started defaulting on their mortgages. The value of mortgage-backed securities plummeted, sending shockwaves through the financial system. The first major tremor was felt in 2007 when New Century Financial, a major subprime lender, filed for bankruptcy. This sent a clear signal that the housing market was in trouble. The situation worsened in 2008 as more financial institutions began to crumble under the weight of their bad investments. The defining moment of the crisis came in September 2008 with the collapse of Lehman Brothers, a venerable investment bank. It was the largest bankruptcy in U.S. history and sent a wave of panic through global markets. Governments around the world stepped in with massive bailouts to prevent a complete financial meltdown. In this chapter, we will delve deeper into the causes and effects of the 2008 stock market crash. To understand the full scope of the crisis, we must first examine the role of financial institutions, government policies, and global economic conditions that contributed to the meltdown. GAP 2S. Financial institutions played a crucial role in the lead-up to the crisis. Banks and mortgage lenders engaged in risky lending practices, issuing subprime mortgages to individuals with poor credit histories. These high-risk loans were then bundled into complex financial instruments known as mortgage-backed securities, which were sold to investors around the world. The lack of transparency and the complexity of these financial products masked the true level of risk involved. GAP 2S. Government policies also played a significant part. Deregulation in the financial sector allowed banks to take on more risk, while the Federal Reserve's low interest rate policy encouraged borrowing and speculation. This created an environment ripe for a housing bubble, where home prices soared beyond sustainable levels. GAP 2S. Global economic conditions further exacerbated the situation. The interconnectedness of financial markets meant that the collapse of the U.S. housing market had far-reaching consequences. As mortgage defaults increased, the value of mortgage-backed securities plummeted, causing massive losses for financial institutions worldwide. GAP 2S. Experts provide their insights on what went wrong and what could have been done to prevent the crash. Some argue that stricter regulatory oversight and more prudent lending practices could have mitigated the impact. Others believe that a more proactive approach by central banks and governments might have averted the crisis altogether. GAP 2S. Understanding the anatomy of the 2008 stock market crash is crucial for preventing future financial disasters. By learning from the mistakes of the past, we can build a more resilient and stable global economy. GAP 2S. In this chapter, we will hear from financial experts who witnessed the 2008 stock market crash firsthand. They will share their experiences, thoughts on the crisis, and the lessons they learned. These interviews will provide a unique perspective on the events that unfolded and the impact on the financial industry. GAP 2S. GAP 2S. It was like watching a slow-motion train wreck. We knew something was wrong, but the extent of the damage was unimaginable. The panic was palpable, and everyone was scrambling to make sense of the chaos. GAP 2S. I remember the day Lehman Brothers collapsed. It was a turning point. The realization that no institution was too big to fail sent shockwaves through the market. The ripple effect was immediate and severe. GAP 2S. The lack of transparency and the complexity of financial instruments like mortgage-backed securities made it nearly impossible to gauge the true risk. We were dealing with a system built on a house of cards. Gap 2S. The human cost was staggering. Beyond the numbers and the market indices, there were real people losing their homes, their jobs, their savings. It was a sobering reminder of the fragility of our financial system. Gap 2S. One of the key lessons we learned was the importance of regulation. The deregulation that preceded the crash allowed for risky behavior that ultimately led to the crisis. Stronger oversight could have made a significant difference. Gap 2S. Looking back, it's clear that we need a more proactive approach to managing economic bubbles. The warning signs were there, but they were ignored. We must learn to act on these signs to prevent future crises. Gap 2S. These first-hand accounts provide invaluable insights into the 2008 stock market crash. By understanding the experiences of those who were on the front lines, we can better prepare for and prevent future financial disasters. Gap 2S. Now let's examine the aftermath of the crash and how it reshaped the global economy. Gap 2S. In this chapter, we will examine the global impact of the 2008 stock market crash. We will explore how different countries were affected, the measures they took to mitigate the damage, and the long-term consequences on their economies. This chapter will highlight the interconnectedness of global financial markets and the ripple effects of the crisis. Gap 2S. Gap 2S. The crash sent shockwaves across the globe, with economies in Europe, Asia, and beyond reeling from the fallout. In Europe, countries like Greece, Ireland, and Spain faced severe debt crises, leading to austerity measures and economic hardship for millions of citizens. Gap 2S. Gap 2S. We saw our GDP plummet, unemployment skyrocket, and the social fabric of our society strain under the pressure. The bailout packages were a necessary evil, but they came with a heavy price, recalls an economist from Greece. Gap 2S. Gap 2S. In Asia, export-driven economies like China and Japan experienced a sharp decline in demand for their goods, leading to factory closures and job losses. The Chinese government responded with a massive stimulus package, investing billions in infrastructure projects to stabilize the economy. Gap 2S. Gap 2S. In Latin America, countries like Brazil and Argentina saw their commodity exports fall, impacting their economic growth. Governments were forced to implement measures to protect their currencies and stabilize their financial systems. Gap 2S. Gap 2S. The crash exposed the vulnerabilities in our economic models. We realized that no nation is an island in the global economy. What happens in one part of the world can have profound effects on others, states a financial analyst from Argentina. Gap 2S. Gap 2S. The long-term consequences of the 2008 crash are still felt today. Many countries have reformed their financial regulations, strengthened oversight, and sought to build more resilient economies. However, the lessons of interconnectedness and the need for global cooperation remain as relevant as ever. Gap 2S. Gap 2S. As we reflect on the global impact of the 2008 stock market crash, it's clear that the crisis reshaped the world economy in profound ways. The interconnectedness of financial markets means that future crises will likely have similar far-reaching effects, making international collaboration and vigilance more important than ever. Gap 2S. Gap 2S. Now, let's examine the aftermath of the crash and how it reshaped the global economy. Gap 2S. In this chapter, we will discuss the recovery process following the 2008 stock market crash. We will look at the steps taken by governments and financial institutions to stabilize the economy, the challenges faced during the recovery, and the progress made over the years. This chapter will provide a comprehensive overview of the efforts to rebuild and strengthen the financial system. Gap 2S. Gap 2S. In the immediate aftermath of the crash, governments around the world took swift action to stabilize their economies. Central banks slashed interest rates, while governments implemented large-scale stimulus packages to inject liquidity into the financial system. Gap 2S. Gap 2S. The coordinated response was unprecedented. We had to act quickly to prevent a total collapse of the financial system, says a former Federal Reserve official. Gap 2S. Gap 2S. Financial institutions were also required to undergo stress tests to ensure their resilience in the face of future economic shocks. These tests helped restore confidence in the banking sector and paved the way for recovery. Gap 2S. Gap 2S. However, the road to recovery was not without its challenges. High levels of debt, weak consumer confidence, and slow job growth hampered efforts to revive the economy. Many countries faced prolonged periods of economic stagnation and high unemployment. Gap 2S. Gap 2S. Despite these obstacles, significant progress has been made over the years. Financial regulations have been strengthened and new policies have been implemented to promote economic stability and growth. GAP 2S. GAP 2S. We've come a long way since 2008. The financial system is more robust, and we've learned valuable lessons about risk management and the importance of regulatory oversight, notes a financial analyst. GAP 2S. GAP 2S. As we reflect on the recovery process, it's clear that the efforts to rebuild and strengthen the financial system have been crucial in preventing another crisis of the same magnitude. The journey has been long and arduous, but the progress made serves as a testament to the resilience and adaptability of the global economy. GAP 2S. GAP 2S. Now let's examine the aftermath of the crash and how it reshaped the global economy. GAP 2S. As we transition from the road to recovery, it's crucial to reflect on the lessons learned from the 2008 stock market crash. This chapter will delve into the importance of financial regulation, responsible lending practices, and the need for constant vigilance in the financial industry. GAP 2S. GAP 2S. The 2008 crisis underscored the dangers of unregulated risk-taking and the fragile nature of the global financial system. In its wake, governments around the world implemented stricter financial regulations to prevent a similar catastrophe. GAP 2S. GAP 2S. The crash was a wake-up call. We realized that without proper oversight, the financial system could easily spiral out of control, says a former financial regulator. GAP 2S. GAP 2S. One of the key takeaways from the crisis was the importance of responsible lending practices. The subprime mortgage crisis, which played a significant role in the crash, highlighted the risks associated with lending to borrowers who are unable to repay their loans. GAP 2S. GAP 2S. We learned that lending should be based on sound financial principles, not on the assumption that housing prices will always rise, notes an economist. GAP 2S. GAP 2S. The need for vigilance in the financial industry cannot be overstated. The interconnectedness of global financial markets means that a crisis in one part of the world can quickly spread to others. Constant monitoring and proactive measures are essential to maintaining stability. GAP 2S. GAP 2S. We must remain vigilant and adaptable. The financial landscape is constantly evolving, and we need to be prepared for new challenges, emphasizes a financial expert. GAP 2S. GAP 2S. As we reflect on the lessons learned from the 2008 crash, it's clear that the importance of financial regulation, responsible lending, and vigilance cannot be ignored. These lessons continue to shape the global economy and serve as a reminder of the need for prudent financial management. GAP 2S. GAP 2S. Now let's examine the aftermath of the crash and how it reshaped the global economy. The 2008 stock market crash had a devastating impact on the global economy. Millions of people lost their jobs, homes, and life savings. The unemployment rate soared, and the world was plunged into a deep recession. The crisis exposed the fragility of the financial system and the dangers of unregulated risk-taking. In the aftermath of the crash, governments implemented stricter financial regulations to prevent a similar crisis from happening again. The lessons learned from 2008 continue to shape the global economy today, serving as a stark reminder of the interconnectedness of financial markets and the importance of responsible lending practices.